Debt Management Office has launched the July 2025 Federal Government of Nigerian Saving Bond offering investors attractive interest rates of up to 16.762% per annum. Welcome to Business Point. It's a program that extrays the Nigerian economy and the government policies. I am your host, Kike Lomo Okeri. The federal government of Nigerian Saving Bond subscription window opened on Monday, July 7, 2025 and will close on Friday, July 11, 2025. The Debt Management Office made the announcement in a circular published on its website. This month's bond offering includes two options: 2-year saving bond maturing on July 16, 2027 with an interest rate of 15.762% and a 3-year bond maturing on July 16, 2028, offering 16.762%. Each bond unit is priced at 1,000 naira with a minimum subscription of 5,000 naira and additional investment in multiple of 1,000 naira, allowing investors to subscribe up to 50 million naira. The settlement date for successful subscription is set for October 16, January 16, and April 16, as well as July 16 each year. This offering gives Nigerians the opportunity to invest in government-backed bond, contributing to a personal and national financial stability. Slightly decrease in interest rates, the 16.762% interest rate represents a decrease from June 2025, when rates stood at 17.12% per annum for the 3-year bond. Similarly, the 2-year bond rate declined to 15.762%, down from 16.12% in June. This is likely driven by Central Bank of Nigeria's decision to retain monetary policy rate at 27.5% in the recent months. The CBN's strategy to address inflation and stabilize the foreign exchange market has made Nigerian bond more attractive, particularly to foreign portfolios investors looking at higher yield. Result from June 2025 saving bond shows that the federal government raised 4.01 billion naira through its FGN saving bond auction, reflecting strong demand for long-term securities. The June 2025 allotment is slightly lower than the 4.28 billion naira recorded in May 2025. DMO data reveals that 2-year bond received 2.01 billion naira in total allotment with 1,202 successful subscriptions, while 3-year bond attracted 1.995 billion naira spread across 1,321 successful subscriptions in June 2025. Recall that the federal government of Nigeria Saving Bond program introduced in 2017 was designed to deepen the domestic bond market, promote financial inclusion, and offer retail investors access to secure and low-risk government securities. The FGN Saving Bond qualifies as an approved investment under the Trustees Investment Act and is also recognized as a government security under both Company Income Tax Act and Personal Income Tax Act. This makes it eligible for tax exemption by pension fund and other qualified institutional investors. Furthermore, the bonds are listed on the Nigerian Exchange Limited (NGX), providing investors with the option to trade them on secondary markets and enhancing overall liquidity. They also qualify as liquidity assets for purpose of computing bank liquidity ratios. Over the years, FGN saving bond has become increasingly popular among Nigerians looking for safe and predictable investment options. Amid concern over inflation and volatility interest rates in traditional saving products, this government-backed bond offers stability and consistent returns. As of the end of first quarter of 2025, at least 5 banks have met new capital threshold issued by Central Bank of Nigeria. They include Access Bank, Zenith Bank, Eco Bank, Nigerian Lotus Bank, and Jaiz Bank. In March 2024, the Central Bank of Nigeria directed commercial banks with international authorities to increase their capital base to 500 billion naira and National Bank to 200 billion naira, while those with regional authorization are expected to achieve 50 billion naira capital floor. Similarly, non-interest bank with a national and regional authorization will need to increase their capital to 20 billion naira and 10 billion naira respectively. CBN gave the bank a deadline of March 2026. Access Bank was the first tier lender to hit the 500 billion naira new capital threshold for bank with international authorization as set by the CBN. Its parent company Access Holding announced in late December that it had received regulatory approval for its 351 billion naira rights issue. The HoldCo said with success, the bank share capital would raise to 600 billion naira and 100 billion naira above the regulatory minimum requirement. With this feat, Access Bank was able to cross the threshold within the same year as the CBN directive. Following was Zenith Bank PLC, which raised 350.4 billion naira from its combined rights issued and public offer to cross the threshold. With the additional rise, the bank share capital rose to 614.65 billion naira, which is 114.65 billion naira above the regulatory minimum requirement. Next was Eco Bank Nigeria, a national bank which Fitch Ratings says needed only a small capital injection to meet the requirement and has already achieved compliance. It's however estimated that the lender was still in breach of its total capital adequacy ratio requirement of 10%, but it further capital rising plans to restore compliance. Meanwhile, the bank's parent company, Eco Bank Transitional Incorporated, successfully tapped its $400 million, that is 10.125%, noted due October 15, 2029, for an additional $125 million in May 2025. The non-interest bank, Lotus Bank, reveals that its capital base already exceeded the 20 billion naira required for a national non-interest bank. Speaking at the media parley in 2024, an executive director at the bank, Isiaka Ajani Lawal, who represented the managing director Kafayat Araoye, says before Central Bank of Nigeria announced the new minimum capital base, the bank had it as a national bank. In early January, another non-interest bank lender, Jaiz Bank, announced that it had crossed the new capital threshold with listing of its 10.04 billion naira from its private placement of the Nigerian Exchange Group following regulatory approval from CBN, Securities and Exchange Commission and the NGX. With less than a year to go before the expiration of the CBN deadline, other banks have started the second leg of their capital raise. During the first phase, a majority of them indicated that private placement and debt market and the international capital market were all avenues through which they could raise the required fund. Last Thursday, the Guaranteed Trust Holding Company stepped into the global capital market as it indicates that it will be seeking to raise $100 million from the international capital market and list its security on the London Stock Exchange main market. GTCO added that the capital raise is aimed at completing its capital raising efforts, GTCO raised 209 billion naira via a public offer in July 2024 and said the net proceed of a new offer will be used primarily for further recapitalization of GT Bank Nigeria and its growth strategy. GTCO, while announcing the launch of a full marketed offering of new ordinary shares, also gave notice of its intention to cancel the listing of its existing global depository receipt in the certificate representing certain securities, that is, depository receipt, category of the official list of the United Kingdom Financial Conduct Authority, and in place of the GDRS, the company's ordinary shares will be listed on London Stock Exchange main market. Commenting on the offer, the Group Chief Executive Officer of GTCO, Segun Agbade, says this offering and transition to a full listing on the official list of the FCA and to trading of the company's share on the London Stock Exchange main market for listed security represents a pivotal moment in GTCO's growth, reinforcing the bank's position as a forward-thinking Africa financial service institution. This move builds on the bank's tradition of many firsts and innovation as the bank continues to create exceptional value for stakeholders, customers, and broader stakeholders. The bank reiterated consistent track record of strong performance underpinned by disciplined execution and a relentless focus on customers' excellence. In its fiscal year in 2024 result presentation, Tier 1 Bank First Holdco revealed that it intends to raise 350 billion naira in additional capital with private placement as an option and a target of the second quarter of 2025 for its banking subsidiary to comply with the minimum capital requirement. When done, the financial holding company is eyeing 748 billion naira in paid-up capital. Following was Zenith Bank PLC, which raised 350.4 billion naira from its combined right issue and public offer to cross the threshold. With the additional raise, the bank share capital rose to 614.65 billion naira, which is 114.65 billion naira above the regulatory minimum requirement. Next was Ecobank Nigeria, a national bank which Fitch Ratings said needed only a small capital injection to meet the requirement and has already achieved its compliance. It, however, estimated that the lender was still in breach of its total capital adequacy ratio requirement of 10%, but it has further capital raising plans to restore compliance. Meanwhile, the bank parent Ecobank Transitional Incorporated successfully tapped into the $400 million, that is 10.12% notes due October 15, 2029. All right, let's take a quick short break. We'll be right back. Don't go away. Stay with us. Welcome back. If you're just joining us, this is Business Point on Global Television. It's a program that extracts the Nigerian economy and the government policies. The Federal Inland Revenue has commenced formal renegotiation of its double taxation agreement with the Kingdom of the Netherlands. The talks marks the first engagement following the signing of Nigerian Landmark Tax Reform Bill into law by President Bola Ahmed Tinubu on June 26, 2025. According to a statement from the FIRS, the Executive Secretary, FIRS, Dr. Zach Adedeji, described the renegotiation as both timely and necessary, given the evolving tax landscape at home and abroad. Recent developments in the domestic and global tax landscape have made the review of the existing agreement unavoidable. He explained that the tax reform being carried out by the federal government of Nigeria, global measures against base erosion and profiting shifting, and other evolving international tax standards will render extant agreements out of date. He noted that renegotiation is fully aligned with the Tinubu's administration's broader fiscal objective of broadening the domestic tax base, strengthening tax administration, and ensuring that tax systems support inclusive economic growth. The Netherlands is one of Nigeria's long-standing trade and investment partners and has become the first foreign government to initiate formal talks to realign its tax agreement with Nigeria's new tax framework. The existing treaty, which includes provision aimed at preventing double taxation, is now seen as outdated in light of the recent reform. Ambassador Van Lodrege echoed the cooperative tone of the negotiation, expressing confidence in both delegation capacity to reach a beneficial agreement. This newly signed tax law, which include the Nigerian Tax Act, Nigerian Tax Administration Act, Nigerian Revenue Service Act, and Joint Tax Board Act, represents the most comprehensive overhaul of Nigerian tax system in decades. They paved the way for the official launch of the Nigerian Revenue Service on January 1st, 2026. According to the FIRA boss, in preparation for that transition, the next 6 months will be used to harmonize tax data, implement new systems, and update tax treaties to reflect modernized structure. All right, let's take a look at the stock markets. Analysts at Cardinal Stone are projecting Nigerian GDP in the first half of 2025 to grow at its fastest pace since 2014, fueled largely by renewed activity in the oil and gas sector. The forecast was detailed in their media economic outlook titled Charting the Sustainable Path. According to the report, GDP growth is expected to be driven by a revitalized oil and gas sector supported by full-scale operation of the Dangote refinery. Highlighting the role of the inflation in shaping this outlook, the analyst noted that real growth is also expected to reflect sustained moderation of inflation to 20.0% from an average of 33.0% in 2024, adding that a more stable exchange rate environment would rather support growth by easing pressure on consumer spending and reducing corporate cost burden. Regarding sector preference for the second half of the year, Cardinal Stone favored upstream oil and gas and naming Seplat and Adel as their top pick with buy recommendations. According to the analyst, their bullish view on Seplat and Adel stems from the strength and expected profitability of recent strategic transactions by both companies. Seplat review an 11% increase in the total production its acquisition of Mobil Producing Nigerian Limited, now renamed Seplat Energy Producing Nigerian Unlimited. In late 2024, as reviewed by Seplat, onshore assets averaged 48,618 barrels of oil equivalent per day in 2024, a slight rise from 47,758 barrels of oil equivalent per day in 2023, with Seplat Energy Producing Nigerian Unlimited fully integrated and on annualized contribution of 4,329 barrels of oil equivalent per day lifted overall production to 52,947 barrels of oil equivalent per day. Analysts believe that consolidation will meaningfully boost Seplat production capacity and reserve profile in the second half of the year. The consortium, which include ADEL alongside other Nigerian and international energy players, completed the acquisition of Shell Petroleum Development Company of Nigeria in March 2025. Despite this positive company-specific development, the broader oil and gas sector declined by 10.12% on Nigerian stock market in the first half of 2025. The Nigerian oil and gas sector, as tracked by the NGX Oil and Gas Index, saw a challenging first half of 2025, closing lower in 5 out of 6 months. The index opened the year at 2,712.1 points, but declined steadily through May, falling to 2,327.2 points and shedding to 384.9 points in the process. This pullback likely created a potential retracement zone for buyers, with possibility upside targets above 2,600 level. June brought a shift in momentum, with the sector posting a 4.7% gain and closing the month at 2,433.5, supported by a market of 538 million. Early July has continued to reflect bullish sentiment as the sector eye levels above 2,600 and a rally among gas stocks. The Nigerian gas flaring has surged to its highest level in the 4-year, raising concern about the country's commitment to climate goals and exacerbating the energy challenges faced by domestic industry reliant on natural gas. According to data obtained from the Nigerian Oil Spill Monitor and corroborated by the National Oil Spill Detection and Response Agency (NOSDRA), oil and gas companies operating in Nigeria flared an estimated 301.1 standard cubic feet of gas in 2024. An analyst of gas flaring data from NOSDRA reveals that Nigeria lost an estimated $1.1 billion in potential revenue due to gas flaring. Of this, only $602.2 million is recoverable as penalties, representing just 54% of the total value that could have been earned. Further analysis shows that between January and May 2025, the country flared 154.1 million standard cubic feet of gas, marking the highest volume of flared gas recorded in the first 5-month period since 2020. This surge in flaring comes despite the federal government's commitment to end routine gas flaring by 2030 under the Nigerian Gas Flaring Commercialization Program. Gas flaring, the burning of the natural gas associated with the oil extraction, contributes significantly to greenhouse gas emission. Nigerian African top oil producers has pledged to end routine gas flaring by 2030 under the World Bank Zero Routine Flaring Initiative. Yet progress has been sluggish. Industry analysts attributed the increase to a combination of aging infrastructure, poor enforcement of environmental regulation, and delay in implementing gas commercialization policies. In 2016, and gas flaring, venting, and maintain emission regulation of 2023 a significant initiative aimed at ensuring local gas availability in various forms to improve the standard of living in Nigeria and boost the country's GDP. President Donald Trump has announced that Nigeria will be among the countries facing additional 10% tariff for aligning with what he described as the anti-American policies of BRICS. The U.S. president made the declaration via a post on Truth Social, adding fresh uncertainty to global trade relations. Trump's announcement, which did not elaborate on any specific policy of the BRICS, came as the group's meeting is underway in Rio de Janeiro in Brazil. The Brazil government on January 17, 2025, announced the formal admission of Nigeria as a partner country of the grouping. Nigeria became the 9th partner country of the BRICS, joining Belarus, Bolivia, Cuba, Kazakhstan, among others. This partners country category was created during the 16th BRICS summit held in Kazan in 2024. Trump's alt tariff hike on most trade partners raises China duty to 125%, drops cents, set August 1 tariff deadline as global trade talks intensify. All right, this is where we draw the curtain on Business Point today. Join me again tomorrow on Global Television Channel 365 and 276 on Star Time. To stay connected, kindly follow us on all our social media platforms. Till I come your way again, I am Kike Lomo Okeri. I celebrate you all.